The Federal Reserve's Reverse Repo Facility, a comprehensive analysis. For the first time since June 2021, the Federal Reserve has adjusted the reverse repo facility, potentially depleting it entirely. This significant move marks a pivotal moment in the financial landscape, as it could have far-reaching implications for the economy. Over the next few minutes, we will explore the intricacies of the reverse repo facility, its historical context, and the potential impact of recent changes. Understanding the reverse repo facility. The reverse repo facility is a tool used by the Federal Reserve to manage liquidity in the financial system. It allows banks to lend their cash to the Fed in exchange for temporary collateral, typically U.S. Treasury securities. This mechanism helps banks balance their increased liabilities by providing them with assets. Initially, when the money printing began in 2020, the reverse repo facility had a 0% interest rate, akin to the federal funds rate. The Federal Reserve's action wasn't merely about printing money but involved purchasing assets, primarily treasuries, from banks, which then lent the money back to the government, contributing to various spending programs. The surge in reverse repo activity. Cash began to flood into this facility in 2021, peaking around $2.3 trillion in 2022. This series of transactions led to an influx of cash in the financial system but fewer available assets, prompting banks to seek assets to balance their increased liabilities. To address this, the Federal Reserve offered the reverse repo facility, allowing banks to lend their cash back to the Fed in exchange for temporary collateral. In June 2021, the Fed raised the interest rate on these transactions to 5 basis points above the lower end of the federal funds rate, effectively incentivizing banks to park their cash in this facility. This strategy successfully accumulated $2.3 trillion in the reverse repo facility over several years. The Fed's strategy to combat inflation. As the Fed began combating inflation by raising interest rates, it maintained a premium on the reverse repo rate to prevent the cash from re-entering the economy and further stimulating it. Consequently, banks were paid substantial amounts to keep their cash with the Fed overnight, rather than using it productively. Recent changes indicate that both the reverse repo rate and the lower bound of the federal funds rate are now aligned at 4.25%, eliminating the incentive for banks to hold excess cash in the reverse repo facility. This strategic alignment reflects the Fed's evolving approach to managing liquidity and inflation. The implications of a depleted reverse repo facility. With only $98 billion remaining, the facility is nearly depleted, prompting cash to move into the T-bill market. T-bill rates are expected to stabilize just above 4.25%, reflecting the slight additional risk they carry compared to direct dealings with the Federal Reserve. The timing of this shift suggests the Fed is less concerned about withholding liquidity from the market, balancing inflation concerns with the risk of a deflationary spiral and government default. The Fed's current stance indicates a potential shift away from maintaining a floor under interest rates, although inflation remains high. The future of monetary policy. This may result in a pause on rate cuts or even a reversal to rate hikes, reminiscent of the 1970 scenario. The Fed's decision to adjust the reverse repo facility signals a nuanced approach to addressing the complex economic challenges of the present day. Ultimately, the reverse repo facility saga appears to be concluding, as the Fed removes the premium incentive, allowing liquidity to re-enter the T-bill market to assist the government's financial needs. This move could potentially stabilize the financial system, but it also raises questions about the long-term implications for monetary policy and economic stability. Conclusion: navigating the financial landscape. The Federal Reserve's adjustment of the reverse repo facility marks a significant shift in monetary policy, with potential ramifications for the economy at large. As we navigate this evolving financial landscape, it is crucial to stay informed about the Fed's strategies and their implications for inflation, interest rates, and economic growth. By understanding the intricacies of the reverse repo facility and its role in the financial system, we can better anticipate the potential impacts of these changes and make informed decisions about our financial futures.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.